In this video, we discuss exactly what happens if the market crashes right after you retire and some strategies you can use to protect yourself. Coming up next on Holy Schmidt.
Holy Schmidt!
Imagine working for 40 years. You save diligently, you invest wisely, and when the big day comes, you celebrate with your family. You walk out the door from your old place of employment, and the very next day, there's an announcement. Something has happened in the world, and your portfolio starts to drop. And it continues to drop, and after 2 or 3 months, it's down 25%. Many people who are getting ready to retire or who recently retired have been watching the markets over the last few weeks, and they're getting nervous. In the video, I'm going to show you what happens to a hypothetical $100,000 portfolio when someone retires during a market crash. I'm going to pick 2 of the worst market crashes in the last 30 years as an example. All right, let's jump into it. We're going to assume that someone retires and they withdraw 4% of the starting value of their portfolio plus inflation along the way. So they are consistently taking 4% in real dollars from the value of their starting portfolio. By the way, if that 4% sounds familiar to you, that's the 4% rule. It's one of the standard rules in retirement that may or may not work all of the time. Now, we took 30 years of data and we said, what would be the worst possible retirement points for someone with $100,000 over the last 30 years? Meaning, what would their portfolio look like 10 years in the future if they followed this rule? And there were 2 clear losers or winners, depending on how you look at it, that stood out. And by the way, the investment is just the standard S&P 500 index with dividends reinvested. So over the last 30 years, the average return was 10.5% roughly. This is important because most people assume that the stock market averages 7 or 8% per year. And so no matter when you retire, you're going to kind of get that over the long run. And so it doesn't really matter whether you have a bad year or 2 here or a bad year or 2 there. As long as you average between 7 and 8%, you're going to do just fine. But that's not the case. But retirement doesn't happen over a long average period of time. It happens on a specific day. And that day is the day you stop contributing to your retirement account and you start drawing from your retirement account. And that change matters because the moment you start drawing from your retirement account, the sequence of returns from your retirement investments matters greatly. And to be very clear about this, if you were 20 years into a 40-year career and the market dropped 25%, well, that's a buying opportunity. Warren Buffett would say, buy when others are fearful and fear when others are greedy, or something like that. But the point is, it isn't a bad outcome for you if you have 20 years to go in the future. But now when you're spending what you have in your investments, you have something called sequence of return risk. And that basically means that if you start off badly, it becomes very hard to recover later. Let me show you exactly what this looks like with real data. We pulled 30 years of monthly S&P total returns from January 1996 through December 2025, with dividends reinvested. Real data, no hypotheticals. Over those 30 years, $100 invested in the S&P grew to roughly $1,900. That's about 10.5% annualized, a great long-term return. Then we ran a simulation. We tested every single possible retirement start date across those 30 years. We tested those every single month. Each retiree started with $100,000 and followed the 4% rule, adjusted for inflation using the CPI-W index. What is CPI-W? That's the Consumer Price Index for urban wage earners and clerical workers. It's the same benchmark that's used to determine the cost of living adjustment for Social Security. And it's a pretty accurate benchmark overall for how people spend in society today. The 4% rule assumes that you start off with $4,000 on a $100,000 portfolio, and that $4,000 increases with inflation for the rest of your life. It's considered a safe rule because the math suggests that you won't run out of funds within your lifetime anyway, at least under most normal scenarios. We did the analysis and we said, what were the 2 worst times to retire over that 30-year period, with one caveat, and that was that they had to be 5 years apart. You couldn't have one worst time being 1 month different than another worst time because it's the same event, whatever that event is, that's causing the problem. So there had to be at least 5 years in between. And here's what we found. The number 1 worst time to retire was August of 2000, right at the dot-com peak. Over the next 10 years, the retiree would take out $4,000 per year plus inflation. That's $40,000 plus about another $5,000 in inflation. So a total of $45,000 in that 10-year period of time. Over that same period of time, that $100,000 portfolio with annual withdrawals of 4% plus inflation ended down to $40,000. It was down 60% after 10 years. So what happened with this retiree? Well, they weren't facing just one market crisis, they were facing two. The first was the dot-com bubble, and the second was the global financial crisis that started in 2007. So by the time their 10 years were up, their portfolio was pretty much decimated. Now, the second worst time would have been to retire in May of 2007. If you had retired in May of 2007 and you followed the 4% rule, your portfolio would be up slightly. It would be at $115,000. Not terrible, but that retiree barely kept ahead. Now, what's really important here is that they both followed the same rule and they both had the same starting amount, and they had a reasonably long period of time, and one was drastically different than the other, and both were not that good. Why did that happen? Well, the math is pretty straightforward. When you withdraw money during a market crisis, you're forced to sell more shares at a lower price to generate the same amount of income. Those shares are gone permanently. They cannot participate when the market rebounds later. Over time, this creates a compounding effect. The portfolio has fewer shares working for it, therefore it continues to struggle to grow. The 2000 retiree didn't make bad market choices. They made the same market choice as the 2007 retiree. They just happened to be in the wrong place at the wrong time, so to speak. So could this happen in the future? It's very likely that something like this will happen in the future. In fact, if you are getting ready to retire or you're recently retired, it's highly likely that you'll see an event like this during your retirement. Hopefully it's later in retirement, but the odds are there that it's going to happen again, and maybe even again. But let me show you something interesting. One of the most powerful findings we had in this exercise we did for this video was what happens if the August 2000 retiree, who would have ended up with $40,000 at the end of 10 years, waited 1 year. Let's say that they started to draw on their portfolio in August of 2001. Well, their portfolio at the end of 10 years was $69,000. What happens if they waited 2 years? Well, then it was $126,000. The point here is that a lot of times you can't tell when you're entering a bear market. But when the dot-com bubble exploded and when the global financial crisis hit and Congress was convening to figure out how to bail out the banks, you remember that time, it was pretty clear that the markets were not going to be in good shape. Even the lead up to that time, you saw things starting to turn. So you could make a decision not to start if you so chose. Waiting 2 years turned a 60% loss into a 26% gain. Now, the S&P was still volatile during that decade. There's no getting around that. But by waiting, the person who would have sold at the worst possible time, in fact, did not sell at the worst possible time. What about the person who retired in May of 2007? At the end of 10 years, their portfolio was only $115,000. What if they had waited 1 year? Well, then it would have been $153,000 at the end of that decade. If they had waited 2, it would have been $303,000. You get the point. Now, I'm not trying to tell you that you should try to time the market. No one's going to ring the bell when the bottom has been hit and things are moving up. But these numbers show why having flexibility around your retirement date can save you hundreds of thousands of dollars. If you can push your retirement back a year or two and continue to contribute at the lower price multiples, it might end up being a really good thing. Many financial planners refer to the first 5 years of retirement as the retirement danger zone because of exactly what I just talked about. During this retirement danger zone window, portfolios are most sensitive to market downturns. The reason is simple, because that's when your portfolio is biggest, and that's when people tend to spend more money, early retirement. If markets tend to do well during early retirement, the big portfolio tends to grow very quickly, and that sets the bar for the rest of retirement. If they don't perform well, then it creates the opposite effect. Gang, if you're watching this, and you're asking the question, how will my portfolio handle sequencing risk? This is a calculation you can actually do on your own. Our partner Bolden has a retirement planning tool that lets you model different withdrawal strategies, test your portfolio against actual historical market scenarios, and see how changes to your plan affect your long-term outcomes. I use Bolden myself, and they're one of only 3 affiliates we recommend on this channel. What I like most about Bolden is that they don't just give you one number. They give you a number for a good market, a bad market, a medium market, and they give you a probability of success score. If you'd like to try their full-featured software free for 2 weeks, you can use our affiliate link Just go to go.bolden.com/Schmidt. You can try it free for 2 weeks, and if you like it, you can keep it. It's $12 a month paid annually. Now, we just showed you the 2 worst times to retire over the last 30 years, just to illustrate the fact that it does happen more than once in a lifetime, but also the differences between the two and the outcomes for delaying. Then we asked ourselves, since we have the data, what would be the best possible time to retire over the last 30 years? And that would be March of 2009. If you had retired with $100,000 in March of 2009, you took out $45,000 over the course of the next 10 years, and you asked yourself, what would be the dollar value at the end of that time? $369,000. Let me state it differently. The August 2000 retiree who took out $45,000 over the course of the next 10 years ended that period of time with $40,000. The March 2009 retiree who also took out $45,000 over the next 10 years ended that decade with $369,000. That's a 9x difference. Same withdrawal rules, same market, the S&P 500 index, same 30-year average, 10.5%, but vastly different outcome. That is the sequence of return risk, and it is the most important concept that most retirees have never heard of. Now, we see a lot of people who put information in the comments section about how they invest, and some of them will say, I put everything in equities, but I will keep a year or two of cash on hand just in case there's a problem. But let's look at this a little bit differently. What would happen if we took the same $100,000 and invested 50% of it in the S&P 500 and the other 50% in 30-year government bonds? In August of 2000, the 30-year government bond had a coupon of 5.68%. That was guaranteed year after year for the next 30 years. If you had invested $100,000 in the S&P 500 index, that would have been $40,000 at the end of the decade. But what happens if you put 50% of that $100,000 in 30-year government bonds? Well, the portfolio goes from $40,000 to $89,000 in 10 years. The bond allocation more than doubled the outcome, and that bond kept providing 5.68% per year for the next 30 years, on top of the fact that the price of the government bond was appreciating because interest rates were dropping. The May 2007 retiree saw a similar outcome. You recall that S&P 500 only, they had $115,000 at the end of the decade. But when you have a 50-50 split and you put in a 30-year government bond that's paying 4.88%, by the way, that number moves up to $128,000. Not as dramatic, but similarly important. So what's one of the big takeaways here? First, don't panic sell. A lot of people will sell when things are going badly because they don't want to lose more. But panic selling usually results in a very bad outcome for the person doing the selling and a very good outcome for the person doing the buying. Unfortunately, selling after a large market downturn locks in the losses, and history has shown time after time after time that some of the biggest gains happen right after some of the biggest losses. Remember our May 2008 retiree, and think back to May 2008 yourself. If that retiree had sold at the end of 1 year, their $100,000 portfolio dropped to $62,000. If they had sold, they would have locked in that loss permanently. So here are some things you can do right now. First, understand that the first 5 years of retirement are the most vulnerable. If you're within 5 years of retirement on either side, pay special attention to your portfolio allocation. Second, consider holding several years of spending in bonds, cash, or other stable assets. We saw that a simple 50-50 stock and bond split more than doubled the outcome for the worst-case retiree. Third, don't panic during a downturn. The retiree who stayed invested through the 2008 crash recovered. Fourth, build flexibility into your spending plan. The ability to reduce withdrawals temporarily during a bad market is one of the most powerful tools you have. Fifth, if you have the option to delay retirement by even a year or two during a major downturn, the data shows that patience can be worth $100,000 or more. And remember, retirement isn't something that happens at a moment in time. It's something that plays out over 20 or 30 years, and the more flexible you are, the more resilient you become. If you want to model your own retirement plan against scenarios like these, check out Bolden. Go to go.bolden.com/Schmidt, and you can try Bolden for 2 weeks for free. After that, it's $12 a month paid annually. If you like this video, check out that video right there. This is Jeff Schmidt, and I will see you in that video.